Did you ever wonder what the three biggest option trading mistakes that retail investors make? Well, today I'm going to go over that in this short video. Listen, I have spoken to hundreds of retail investors, hundreds of institutional investors. I've been trading options for, oh boy, almost 30 years now. And I can tell you the three simplest mistakes that retail investors make, because I get these questions all the time. But before, I want to tell you exactly the difference between what an option is and what a stock is and how you should think about it. Now, if you're buying a stock, you are basically buying something that there's nobody necessarily on the other side of the trade. Sometimes people can be short that stock, but for the most part, there is an outstanding issuance of stock for all companies. You can buy it, you can hold in your brokerage account, and it's not dynamic. It sits there, it pays you dividends. It goes up, it goes down perhaps, but an option contract is different. And here's why. An option contract, when you buy one, there is somebody on the other side of that who's selling you the risk. So for instance, if you buy, let's say, an Apple call that expires 2 weeks from now with a strike price of 160, it gives you the right to purchase stock at 160 at expiration. Now, the person who sold you that contract has the obligation to sell you that stock there. So they're on the hook for selling you the stock if the price goes higher. Then the person who sold you that call option has to sell you the stock at a lower price than where it's trading. Now, this is very fundamental to understand in option trading. It's similar to how you buy, let's say, an insurance premium on your house or a life insurance. There's always somebody on the other side of that insurance contract who's underwriting the risk. And in the options market, when you're just buying a call or buying a put, there are institutions and market makers and very sophisticated investors on the other side of those trades that are writing you that risk, that understand not only the value and the price of that option better than the retail investor does, but also have a better grasp on where the underlying asset will be at expiration. So let me tell you the three biggest mistakes that common or retail option investors make. Number one is buying and holding long options. Now, why is this a bad idea? Because every single day that you own an options contract, it is losing value. And the reason for that is there is time decay. You're going to pay a premium for time, and every day a little bit of that premium is eroding. Now, this premium actually accelerates as you get closer to expiration. So with a month to go, you start to see the premiums and options really start to drain. And that's where option holders lose the majority of their value. The key to this is just not sitting in long options for long periods of time. If you're going to buy an option on the market, whether it's a bet that the market's going to go up like a call option, or a bet the market's going to go down with a put option, you don't want to hold it for longer than a week, because you're going to lose so much value in time decay. It's going to be hard for you to actually make money trading it. So the key is not holding long options for extended periods of time. Number two, a common mistake I see is that investors buy call options after a stock drops. And, this might be enticing. You might see your favorite stock like Microsoft drop 5%, and it bounces because the dip buyers come in. So you go in, then you buy a call option. Now, the reason why this is bad is because after a stock makes a big move, especially a downward move, there is a higher amount of volatility that's priced in the stock. So the premium is going to be higher. Think about it like if you were to buy insurance on your car after you just got in a bad accident, or you got a speeding ticket, the insurance price is going to be higher. It's the same thing for options. If you're buying a call option or a put option on a stock after it drops significantly, then you're just going to be paying a higher premium. And even if it bounces, you have to overcome that premium to make money, because as that stock bounces from the lows, the premium is going to drain out. So that number two rule is don't buy call options specifically after a stock drops. The better strategy really is to just sell puts or sell downward put spreads on it. Number three, another mistake I see a lot of retail investors make, and I've made this before in my career, is buying options around earning events. And the reason why you don't want to do this is because the market and market makers and option traders understand that when a stock has earnings, there is a possibility that there's going to be a bigger move than normal. Okay, so when you're buying an option around an earnings event, you're paying a higher premium than normal. My favorite strategy is waiting until the news is out. And if it's good, if the stock is up and looks like it has momentum, you'll see those the vols drop on options. They become a lot cheaper. And then you could buy them and go for the sort of the post earnings move. So the key is not to buy options around earning events. Now, this is not a foolproof plan. And oftentimes people will go and buy call options ahead of, like Tesla's earnings or Amazon earnings, and it will work out really well. But if you're constantly buying rich options, those are ones that have high premiums, and not selling those options, you will lose money over time. And, the point in case is that these crazy statistics that the Chicago Board of Options Exchange points out is that something like 90% of options wind up going out at zero at expiration. So it's very difficult for you to make money on long options. This is why I created a system that helps you write premium on the market like market makers do, like institutional investors do. I'm excited to launch it in the next week and a half. There's a link below this webinar. Sign up for our list and please join me on January 20th. If you like what we have in these videos, always please smash that like button, sign up for our list, and I'll see you on January 20th. Thanks a lot.